Markets with low supply, rents will rise. Markets with high supply, rents will be flat or slightly negative. And that's what we're seeing, and that's what we expect to see for the next rest of 2024. There's a lot of people saying 2025 has no supply. That's not true. That is not true. Supply in 2025 is still robust.
Welcome back to another episode of the Keeping It Real Estate Show. Today we have an incredible guest joining us on the show for the second time, Neal Bawa. And Neal has over $1 billion of commercial real estate under management, speaks at dozens of real estate conferences across the country. I actually got the chance to listen to him down at Raise Fest about a month ago, and he did a phenomenal job. And we'll talk about some of the info that he shared there. And he's really known as the data king. He is data driven, and I absolutely love that. Neal, welcome to the show. It's a pleasure to have you with us today.
Well, thanks for having me back. You know, we're trying to keep it real, and this is the best way to do it.
You got it. Well, super excited to dive into some of the data on the current market. Obviously, you're a specialist in that. But before we do that, you know, if anyone missed the episode that you're on, which was 104, can you give us a little bit of your background and how you got into real estate investing?
Sure. I am a computer science graduate, data scientist by profession. Been in technology all my life, ran a company for 14 years, exited that company successfully, sold to a private equity firm. And all the time that I was running that company, I was investing into real estate because I live in California. My taxes were ridiculously high. And so I was investing in real estate for myself for an entire decade. And then in the second decade of my real estate journey, took money from other nerdy investors like myself who were very interested in the real estate data science that we were publishing. We were ranking all of the 323 metros in the US every year, pointing out which ones were oversaturated, undersaturated, which ones were interesting opportunities. And so a community of geeks and nerds sort of coalesced around us, and that community went on to give us roughly $315 million of their equity for that $1 billion portfolio, which, by the way, at this point is down to $700 million. So I no longer have a $1 billion portfolio because values are down, in my mind, 30%.
Got it. That makes total sense. And, that kind of circles to the next question that I have. Obviously, a lot has happened over the last 5 months since you were on our last podcast, episode 104. What have you seen happen over the last 6 months and also over the last 12 months? And I want to hear the good, the bad, and the ugly, if possible.
Well, I think it's fascinating that we are in an economy where good is bad and bad is good, right? So normally what happens is if you were to see the absolutely astonishing job growth numbers that the United States has produced in the last 9 months, that would be cause for celebration. And in most instances, I would be celebrating, and so would be everyone else in commercial real estate, my brethren. Oddly enough, everyone is terrified of yet another good job report. Everyone's terrified of yet, inflation staying higher, because when you have a lot of jobs, it's hard for inflation to get down. And so we're terrified of growth. We're terrified of the US economy doing well. I mean, so we're in a bizarre situation where the interests of commercial real estate are inversely proportional to the interests of average Americans. I'm sure Americans love the fact that for the last 10 months, maybe 11 months, have had higher payroll growth, meaning higher growth in their salaries than there's inflation. So inflation obviously was 9.1% last year in June. It's now somewhere between 3 and 3.5%, depending upon which metric you look at. But, that's a decent range. But wage growth is over 4%. It has been over 4% for a while. In fact, it was over 5% a while back. So Americans now are seeing wage growth being higher than inflation. So they're finally beginning to enjoy some of the benefits of this economy being that strong. The challenge, of course, is this is making things more difficult for lenders, banks. It's making things more difficult for us in commercial real estate because the industry expected the first rate cut to be in December 2023. Here we are in April. And now at this point, the consensus is that the first rate cut may not even come in July. So it was supposed to be June. And now it's the consensus that it may not happen in July. Now, I am of the opinion that things are not as bright and happy as the media is making it out to be. There are actually significant weakness developing in the US economy, and we've already started to see some cracks there. Those cracks will not show up in the numbers that we are seeing either on the inflation side or the job side for at least another 3 to 4 months. So I do believe that the first rate cut will come in July. We'll see what happens. There are even people saying that the Fed won't cut at all this year, which may be the case. And who would go against these people that are in power? We're nobodies. So we have this bizarre situation, and this bizarre situation is further compounded by the fact that today is probably one of the best times to buy commercial real estate, whether it's office or multifamily, because prices have gone down for office and multifamily. This is not the case for self-storage, hotels, or retail, where prices have not yet dropped. They will drop, but they haven't dropped yet. Because those areas, retail, for example, occupancy is very high, vacancy is very low. Hotels, their average daily rates have spiked, and so they're doing really well. So both of these areas have not yet seen the price decline that inevitably should follow such high interest rate increases. Multifamily, office have seen dramatic decreases in prices. So it's actually a great time to buy assets. But for existing assets, including the asset that I'm holding, you're holding, we are all going through extremely stressful times. And I don't expect that stress to change over the next 12 months, maybe not even for 18 months. So a very trying time, but also a time of great opportunity, both at the same time, which, if you think about it, was exactly the way it was in between the 2008 and 2011 timeframe. Very stressful and a great opportunity at the same time.
So, obviously there's some distress coming down the pipeline because interest rates have been, high over the last 12 months and they've been going up. We don't know exactly when rate cuts are going to, step in. Plus, real estate is slow to react. So even if they start cutting rates this July, like you think they may, it's probably going to take some time for values to increase back up. With that said, how much distress do you think is in the market? Because it seems like there hasn't been that much blood on the streets yet, but it may be, pent up, and we might see some, coming down the pipeline. So what are your thoughts there, Neal?
Quants like me, the first thing we want to do is when we measure something, we first want to define it. So I'm going to define distress in two different ways, because the problem is there are two different kinds of distress. And so the first kind of distress is in the second half of this year, a large number of multifamily properties, somewhere between 500 and 1,500 properties, will go back to the bank, or most likely will be sold at a price where almost all of the equity within those properties is wiped out. Almost all. Maybe some properties, 80% of the equity is wiped out, some 90, some 100, right? Very few will it be 20 or 30%. It'll be much larger than that. So those properties are now being sold where the investors in those properties, the equity is highly distressed because they lose 80, 90, or 100% of their equity. If that is your definition of distress, we will have somewhere between 500 and 1,500 properties that will be sold like that in the remainder of this year, and maybe into early next year as well, maybe even the first half of next year. But the total number is somewhere in that 1,500 range. By middle of next year, it could be 2,000. So if that is your definition of distress, distress is coming, right? And it will accelerate in the remainder of this year and actually make it harder for multifamily prices to stabilize or go up, even as the Fed starts to cut rates. Even if they don't cut in July, let's say they cut in November, it'll still be hard for prices to stabilize because of these properties being sold. Now, what is most important to understand is none of these properties are being sold at discounted prices. So let's say Michael has two properties. One property Michael bought in the year 2000. And because he bought it in the year 2000, this property has produced astonishing amount of cash flow and astonishing amount of profits. And for whatever reason, Michael wants to sell the property this year. And it's a 200-unit property. He also has another property which is identical to this property. Let's even say it's next to the other property. And Michael bought this property in 2022. It has a variable interest rate, which is killing Michael's profits. So he wants to sell this property too. Well, you have to understand that in today's environment, both of these properties will sell for the same price. This property, you've been holding it for 20 years, it might sell for $50 million. I'm making that number up. The other property will also sell for $50 million. Because both properties are selling for the same price, the second property cannot be called distress Distress, by its very nature, with 2008 as our best example, means that the price of various properties varies and lots of lowball offers are made, which allows some people to get better deals than others. Correct? That is a traditional definition of distress. No such distress exists in the multifamily market today. We'll talk about office in a minute, but in the multifamily space, the market is fully liquid. Every single property that appears on the market that is listed receives at least a dozen offers. Some of them receive dozens of offers. So from the perspective of demand, there is no distress in any multifamily properties that we can see in any market in the United States. They sell at market value. Now that market value is somewhere around 20 to 30% lower than the peak. The peak of the multifamily market was March 2022. So from that artificial peak, prices are now down between 20 and 30%, depending upon asset size, asset location, market, and a bunch of other factors. So one way would be saying, oh my God, these properties are being sold 20 to 30% below what some of them were purchased for. That's distress. The market doesn't think of that as distress. The market says, if there are no buyers to find for a property, that's distress. There's a ridiculous number of buyers available. There's lots of liquidity in the marketplace. Every lender wants to lend against properties. They just want to lend at a lower price. So simultaneously, the multifamily industry has zero distress. And I'll give you another data point. And there are 1,500 to 2,000 properties, mostly in the syndication portion of the multifamily industry, that are all distressed because their investors are going to be extremely happy when these properties sell and almost all of their money is wiped out. Which distress, definition do you want to talk about?
No, that makes a lot of sense. And I appreciate you laying that out there and separating the difference in between the two. I know you had mentioned that pricing has dropped by about 20 to 30%, across the nation in the multifamily space, if you average it out. And that's what we're seeing as well. What are your thoughts on pricing moving forward? Some investors are skittish out there because pricing has dropped so much. They're thinking, hey, I'm going to wait until I possibly see the bottom. Personally, I think it's a great time to get into the market because you can't predict exactly when the bottom is going to hit. But what do you think is going to happen moving forward with cap rates and pricing on multifamily?
Okay. I'm a quant. I look at numbers all day long and I enjoy the process of looking at numbers and remembering them. But even for a quant, my track record of predicting any sort of bottom or any sort of top has been disastrously bad. Now, I may have predicted the right thing. What I'm trying to point out is I almost always predicted at the wrong time. This is also true of the stock market. If you listen to the people in the stock market that manage the most amount of money, whether it's Vanguard or Warren Buffett, they all are very candid in saying that their ability to time the market is close to zero. So, Vanguard doesn't try and time the market. Warren Buffett doesn't try and time the market. What I find is inexperienced people who give themselves too much credit try and time the market, and they don't track their own calls. It's useful to go back and look at my podcast predictions from 1 year, 2 year, 3 year, 4 years, and 5 years before. And what I can generally summarize that it is that I've been warning that prices were too high and people shouldn't buy. So I was right in that. But in terms of when I thought the prices would drop, when I thought the market would turn, I've been just as terrible as just about everybody else I know. So I think that timing the market is actually a fool's errand. It's a fool's errand. And no data, no analytics software exists in the real estate market that can assist you to improve your accuracy significantly. CoStar can't do it, and it's a $17 billion company with immense amounts of data and 1,500 people pouring more data into the software every month. They don't know. And they say they don't know. Point is this. What has worked for people in the last 100 years, whether it's the stock market or Bitcoin or real estate, is understanding when things are cheap. That works. That works very consistently. And to me, things are cheap right now for one very simple reason. Multifamily, over the last, call it 24 months, has, because of this pounding of interest rates by the Fed, right, and this extraordinarily rapid increase in interest rates, has seen a drop in prices, 20 to 30%. But what's interesting is that this drop in prices has come without a drop in income. Net operating income, or NOI, which is the most important single number for multifamily, because it's a business. You base your price based on its income, has not decreased at all in those 24 months. In fact, NOI for 19.6 million units in the United States has actually increased. Small increase in the last 2 years. So you have this weird situation where over the last 24 months, income for multifamily as an asset, a $3 trillion asset in the United States, has gone up and prices have dropped. So all of those price drops have nothing to do with the income of the property. They have entirely to do with interest rates. And interest rates, by their very nature, go up and go down. I don't know when they're going to go up, and I don't know when they're going to go down. But whenever interest rates are extraordinarily high, it makes assets cheap. And whenever interest rates are extraordinarily low, it makes assets ridiculously expensive. So watch a podcast of mine from, let's say, the beginning of 2022, and that's what I'm warning. I'm telling people, don't buy assets. You shouldn't be buying them. Even my students were buying them, which was terrible. I would go out there and say, this is not the right time to buy, because interest rates at the beginning of 2022 were at 4%. So people were buying these kinds of assets, and now all of those assets are in trouble. So today, I think you have an extraordinary opportunity where assets are cheap. I don't know when the bottom is. I'll speculate on the bottom, and I'll tell you that my speculations are usually crap, right? I think multifamily bottoms in Q4 of 2024, right? That might be the bottom. Previously, I thought it was Q2, but because of the economy being so strong, the rate cuts have really been pushed out by 6 months. So I'll say Q4 of 2024. Am I waiting for that? No, because I've been wrong so often with my timing. I know it's cheap. So a lot of investors that are good at this stuff, and I read and I try and learn from them, talk about the smile. The smile is the curve where things start to get cheap. And you know that the next asset you buy might probably be cheaper, and the next one will be cheaper after that. But you know that at some point, some asset that you buy would be the bottom of the market, and then the next one after that would be a little more expensive and a little more expensive. If you buy the smile, right, and that's the only thing you're actually logically capable of, as an average, those assets will do really, really well for those investors. Hopefully, the investors invested in more than one asset, and so they got the benefit of the smile, and that's what you should be telling your investors. But even if they didn't, they got an asset cheaper than it was any time in the last 3 or 4 years. And I think that's good enough. That is all that we are capable of doing. Everything else is just smoke and mirrors and illusion. So I'm buying. I started buying a few months ago. I'm buying assets now. I want to buy an asset every 3 months. If I'm lucky enough, I can buy it with an assumption, which is a superior kind of asset available today, where you basically have somebody that locked in a low interest rate 2 years ago. And so you don't have to deal with today's interest rates. You just get today's discounts. Assumptions are hard to find. Not all of my assets are assumptions, but I'm currently only compensating my acquisitions team on assumption assets, so they don't get their bonuses if it's not an assumption asset, which has made it easier for me to find assumption-based assets. So I think it's not a great time to buy, but it's a good time to buy, right? And it's certainly better than 2 years ago where everyone was saying it's a great time to buy. It's certainly a lot better than that because prices are down. Remember, price cannot change, rates can.
Yeah, that makes complete sense. And I love that you said, bottom line, don't try to time the bottom of the market and buy the smile. That makes all the sense in the world. Neal, what are your thoughts on the dry powder sitting on the sidelines? So obviously a lot of dry powder out there, institutional capital. We have seen some institutional capital come back into the multifamily market recently. For instance, BlackRock, they just invested $10 billion into an acquisition of a REIT. What are your thoughts there, and what do you see, moving forward as these institutional players come back into the market?
So the biggest institutional players like today's market a lot more than 2 years ago, and I'll tell you why. Firstly, institutionals use less leverage than we do. You and I will try and leverage a property to 65% and 70 and 75 and 80. Institutional don't do that. A lot of institutional buyers will leverage a property up to 50 or 55%. I actually invest with a group that leverages only to about 50. And they're doing really, really well. It's very profitable for them right now, and they're distributing cash flow. I'm not. My properties are not. They are. And one of the reasons is they use fixed leverage, so their debt is fixed, and they only leverage it up to 50%. And because they're only using 50% of leverage, they get really good interest rates, better than I get. Right? And they go straight to Fannie and Freddie and buy direct. And I'm jealous of them. I'm jealous of their interest rate. I'm jealous of their ability to raise enough equity to get 50% leverage. But that's what institutional equity is doing. And so, as far as institutional equity is concerned, their horizon is not like mine. I tell my investors I'm going to exit in 5 years, and there's pressure on me once I get beyond the fourth year. Institutional equity just says to their investors, not a good time to sell. We've decided to extend it from 5 to 10. And their investors are used to it. And so their time horizon is, hey, things are cheap right now, we're going to buy them. And at some point in the future, we don't know when, they will get more expensive. And because we're using low leverage and we're using fixed debt, we're not worried about this interest rate environment. So we are now seeing the top end of the market, the true institutional players, BlackRock, Blackstone being perfect examples, start to jump into the marketplace saying, hey, this is a great time. If I'm okay with a 10-year run, I want to do a 5-year run, but I'm okay with a 10-year run, it's a great time to buy. And so the top portion of the market is coming back in. The middle portion of the market, the quasi-institutional family offices, they're still mentally affected by what happened in the last 24 months. So I'm not seeing their dry powder move off the sidelines yet.
Got it. That makes sense. And let's talk a little bit about supply as well. You have a ton of data on supply. Obviously, there's been some oversupply in certain submarkets throughout the country, but you also have permitting that's plummeted in a lot of those markets. And I think when you take a step back, the nation is undersupplied in housing in general. But tell us a little bit more, Neal. What are you seeing?
Supply is a sort of a double-edged sword at this point of time. So that 2024, the year that we're in, has the highest incoming supply of new apartments in this cycle. So, I think the last time we had supply this high was maybe in the 2000s, so maybe at least 15 years ago. I don't know the precise year that had the highest number, but this year's number appears to be somewhere around 600,000 units, depending upon whether I'm quoting CoStar or Yardi Matrix. It's somewhere around 600,000 units of supply. That is usually too much. The US has very high absorption rates for rentals, and I'll explain why our absorption rates are too high. Absorption is good. What that means is as new units come in, they get absorbed into the marketplace very easily. So we have very high absorption. And I'll go ahead and explain the reason. The reason is simply this. In 2013, 45% of American families could afford a starter home. Today, that number is 16. From 45% in 2013 to 16%. Only 16% of Americans can afford the median mortgage today. And that number has never been this low. So this is the least affordable, that it's been lower than 2008, by the way, because we have extremely high single family prices. They haven't come down. They haven't adjusted. They're flat. Since the interest rates started going up, single family has been flat where multifamily has been down. And so the prices are still high, and then interest rates are very high in the sevens, for those buying single family. So if only 16% of Americans can actually afford a median home price, a lot of people will end up going to apartments. So absorption rates are very high, but they're still not high enough this year, and only this year. So we're absorbing somewhere around 450,000 units, and we have 600,000 units. And so the only way to absorb the remaining units is concessions. So most markets in the United States are seeing high concessions. Phoenix is around 7 weeks. Salt Lake City is around 9 or 10 weeks of concessions. What that means is if you sign a 1-year lease, you get 7 weeks for free or 9 weeks for free, right? So that concession means people who are in Class B or B plus apartments are able to move up to a brand new Class A building and get a better quality, but they're not paying anymore, right? Because typically they're paying 20%, 25% more, but they're also getting 2 months of concession, so it's evening out in terms of annual lease cost. They're paying the same as Class B plus. So those Class B pluses, they are having to drop their prices. And as they drop their price, right, they start competing with the Class Cs, which now start seeing pricing pressure. So this is the way it cascades down. There's this belief in our industry, a faulty, nonsensical belief, that Class Cs are not affected when incoming inventory comes in. That's a ridiculous and silly idea. What is true, actually, what is the right thing to say is Class C is not initially affected. So when incoming supply comes in, it affects the existing Class A properties first, which then affect the B pluses, which then affect the Bs, which then affect the C pluses, which then affect the Cs, right? So it's a cascading process, and it takes a significant amount of time before Class C starts to lose occupancy because there's a whole bunch of brand new units that have come into the marketplace. And so some markets are now beginning to see that impact on Class C rents. We're seeing an overall impact on Class C rents now, and they're pretty flat. Some markets they're going up, some markets they're actually down. So that supply is too much for this year. But actually, it's not too much because the United States has gone from a shocking 40+% of Americans being able to afford homes to 16%. And so we desperately need rental housing. And so, ironically, what's bad for the industry in 2024 is really good for America. We needed those units and they arrived at just the right time because right now Americans are getting pounded by inflation. And one of the things they're not getting pounded by is rent inflation. There is no rent inflation in the United States in the last 12 months. Rents haven't gone up, rents haven't gone down. They're the same, but people are getting paid 4% more. So they're getting pounded on food, they're getting pounded on oil, they're not getting pounded on rent anymore. And because there's so much incoming supply, they probably won't get pounded on rent for rent in the next 12 months either, because we still have to dissipate this new inventory, which we successfully will because there's so much absorption right now because of mortgages being that high. So far, we're having a tough time raising our rents, and we're going to have a tough time raising our rents in the next 6 to 9 months. But there's this weird belief in the industry that we may not be able to raise our rents because properties are going to sell for cheap. That has nothing to do with rents. You can sell properties for $10 and they will still charge market rents. So, just because there's some distress in the multifamily market space, people think that somehow that's connected to rents. No, rents are only connected to supply. Markets with low supply, rents will rise. Markets with high supply, rents will be flat or slightly negative. And that's what we're seeing, and that's what we expect to see for the rest of 2024. There's a lot of people saying 2025 has no supply. That's not true. That is not true. Supply in 2025 is still robust, and it's likely to be in balance. So 2024, too much supply. 2025, balance. 2026 is what is affected. When I'm looking at pipelines, it's clear to me that a lot of projects that should have started construction this year in 2024 didn't start construction, which is why the pipeline, the supply incoming pipeline for 2026, it looks really weak. It's very likely that in 2026, demand will be high, supply will be low, and 2026, especially the second half, should be phenomenal for rent growth because it's just not enough supply. And so, too many renters will be fighting over too few units. And then starting 2027, I expect the supply situation to improve and start to build up again in a new cycle. So that's what I see. A lot of this data is really coming from CoStar charts and Yardi matrix charts, and everyone's thinking, I don't think that we see a huge decline in supply in 2025. We see, obviously it reduces from the peak in 2024, but it's really 2026 that we are affecting with these high interest rates.
Got it. And earlier you had mentioned that, obviously single family prices have went up substantially, over the last few years, whereas multifamily were down 20 to 30%. With that said, Neal, what's your advice for someone that's considering either going out and buying some single family rentals or investing in the multifamily space?
You would be insane to invest in single family right now. That is my advice. You would be absolutely insane. Please keep in mind that since 2020, single-family home prices first went up 44%, then plateaued, didn't go down, and then started to go up again roughly by 1 to 2% a year simply because of a lack of supply. The supply, it's not like people are not building new single-family homes. I'm talking about supply in the sale market, right? So there's not enough homes available for sale because of the lock-in effect. The lock-in effect is that there's roughly 20 million American homes that are locked in on interest rates below 4%. And people like me, I have a 1.75% rate. I can't go anywhere, right? Because my mortgage would quadruple if I, basically bought my own home back by selling it and then buying it again. My mortgage would quadruple. I can't go anywhere. I'm locked in. The lock-in effect wanes each year, right? As more and more, some people just have to move because for a job or because something happened, a divorce happened. So every year, the number of those homes that are locked in slowly decreases. As the lock-in effect goes away, we should absolutely see a movement in single family prices. So the best case scenario for single family, which is not an unlikely scenario, is that prices will be flat for the next 5 years. That is the best case single family scenario. When you buy really, really expensive single family real estate, the only reason you buy it is if it's expected to go up further. Well, it could go down a bit, not a lot, but go down a bit, or it could stay flat. and you're buying an extremely high price with at a ridiculously low affordability. I do not understand. I completely fail to understand the premise for buying single family homes right now. I do not understand it.
Got it. Appreciate that information. And another common objection out there, I think, is, people can get 5% interest rates, if they put their money in a money market savings account or a bond or whatnot. What are your thoughts when someone's considering investing in multifamily, where they can get 5-6% cash flow, but obviously they have, additional upside potential, or sticking their money in the bank? What are your thoughts there?
When people try and compare, the fact that they can put 5% in the money market versus make an investment, it is a truly, truly irrational comparison. There is actually no comparison between investing in a multifamily asset, which is depreciated in price by 25%. So you might be getting a discount there. I don't know how big the discount is. I don't want to call it 25%. There's a discount versus doing something that is extremely, extremely short term. So you're an investor. You're making a decision. I have $1 million I can put in a money market, make 50 grand a year. Sure, you can. Or I can basically make an investment in multifamily asset. Here's what I would say to you. It's not even close. This is vastly superior. And here's why. Number one, the chances that you will be making 5% 12 months from now are close to zero. The Federal Reserve is the most conservative of all of the people that have predicted interest rate declines. They're the most conservative. Wall Street was less conservative. Banks were less conservative. They're most conservative. But if you look at their dot plot, that 5% that you're making in 12 months is going to be 4, and in 24 months is going to be 3, and in 36 months is going to be 2%. So over the next 3 years, the average that you're going to make is somewhere around 3.25%. Also, understand that inflation is not at 2% anymore. Remember, why are these money markets giving you 5% now? Because inflation was high and it was at 9%, which made sense for a 5% money market. Well, inflation at some point is going to abate, but right now, inflation's 3.5%. So when you're making 5% in money market, you're really making 1.5%. Understand that. Inflation takes away 3.5% from your buying power. Money markets give you 5, so you're making 1.5%. Your net is 1.5%, right? Now you compare that to multifamily. Today, when you buy an asset, because you're buying it cheaper, you should be able to get, call it 4% cash flow. I'm not going to say you can get 6. Some people can get 6. I can't get 6, so I'm just going to say 4. So now you're going to get 4% cash flow in this asset. But you know what you've done is by buying this asset, not only have you made 4% instead of 5, so you're making 1% less now, but now your asset is growing with inflation. It's getting the benefit of inflation. Whereas what you can expect to see if you put money in money market is, okay, in 3 years, you're going to be down to 3%, but inflation will only be down to 2%. Now you're only going to make 1% net. So 1.5 net, 1% net, these are all horrible numbers. Because if that multifamily performs, it'll make you 20% a year total over 5 years, meaning it'll double your money in 5 years because you're buying a discounted property. So you have a pretty good chance of making 100% over 5 years. So if inflation was 3% over those 5 years, that's 3 multiplied by 5, 15. You made 100, subtract 15 from 100, you made 85% net returns over 5 years. Now let's say it underperforms and doesn't make 85. Let's talk about you making 50 or 60% net after subtracting inflation in 5 years. Okay? Because it underperformed, didn't do well. It was a sucky syndicator that you invested with, 60%. Now in my scenario, over those same 5 years, the money market is 5% this year, then 4, then 3, then 2, then 2. Total that number up. 5 plus 4 plus 3 is 12, plus 2, plus 2. Now you're at 16%. So you've made 16% over 5 years. But over those 5 years, inflation was at 3% a year. So you've made 16, lost 15. You've made 1% compared to 60 in an underperforming multifamily asset and 85 in a performing multifamily asset. And I haven't even talked about the benefits of depreciation. But in one scenario, you made 1% net, not 1% a year, 1% net over 5 years. In the other scenario, you made 60 or 85% before tax benefits. How is this a comparison?
I completely agree with you, Neal, and I appreciate you laying that out there. And I think the other thing on investors' minds is where inflation is at. What if inflation continues to go up? How does that affect multifamily assets and interest rates? What if interest rates go up further? So, what are your thoughts on that?
So you can have only two beliefs. One is inflation will come down and probably not come down to the levels it was before COVID, but it will come down and moderate, call it 2.5 or 3%. That's one kind of belief, right? The other kind of belief is inflation will just stay high for whatever reason. We don't even know why, but we have this belief that inflation will stay at 3.5% because this is the new norm. 3.5% is the new 2%, right? So let's talk about those two scenarios because those are the two likely scenarios, right? We don't know which of those is right, but let's talk about real estate in those two scenarios. So let's talk, the easier one is inflation stays at 3.5%, okay? There are plenty of charts on the internet, which you can ask ChatGPT to summon for you, that shows the correlation between inflation and rents in the United States over the last 50 to 75 years. Should take you roughly 60 seconds to pull one of those graphs up. You'll notice that they are extraordinarily correlated. In the world of statisticians or quants, we call this, a correlation over 0.090 or over 90% correlated. Anything over 90% correlated is almost a fact of life. Rents are highly correlated, over 95%, with inflation. So let us say that 3.5% is the new 2%. Well, in that case, over a 5-year time frame, rent growth is going to average 4%. Because if you look at that chart, you'll notice that not only are they correlated, rents stay higher than inflation. Pick any 10-year time frame from the Second World War to now. Look at the graph, total up inflation, then total up rents. You'll notice rents stay above inflation, right? Over that 10-year period. Because there's the data goes up and down, but over 10 years. And this applies for any 10-year time frame since the Second World War. So if 3.5% is a new number, I'm not afraid. I love it because as a real estate, rents, I will have to underwrite all my properties at 4% rents instead of 3% rent growth, which is what most people are doing right now. And so it's a lovely scenario because you want to own an asset in a high inflation environment, right? I want to give you an example so you understand just how shocking it is. Currently, there are 6 countries in the world that are melting down. They are in free fall. These countries are Sri Lanka, Pakistan, Turkey, Argentina, Ghana, and Nigeria. So I study what happens when there is extraordinary hyperinflation in a marketplace. Argentina is the highest at 280% inflation in a year. You know what this means? If something cost $1 a year ago, now in Argentina it costs $3. Not $1.30, $3, right? Wouldn't it make sense to go to those markets and study what that does to real estate? So in Turkey, real estate has doubled in the last year. I'm not talking about real estate in Istanbul or Ankara. I'm talking about all real estate of any form in Turkey has doubled in the last 12 months. Ask ChatGPT, it will give you examples and show you real numbers. Same thing's happening in Argentina. Same thing in Ghana, Nigeria, right? What is consistently seen is that high inflation leads to two things, high rents and high real estate values. So a scenario where 3.5 is the new 2 is a wonderful scenario for us. It's not bad, it's wonderful. Now, if it goes back down to 2%, then it's not a wonderful scenario. It's business as usual. Because isn't that why people invested in multifamily for the last 20 years? Business as usual. So if it goes down to 2%, you shouldn't be afraid of it. But if it stays up at 3.5%, you should be very excited. And again, that is the math. And you're like, yeah, but this seems like it's too good for real estate. Yes, but have you seen what has happened to real estate values in the last 80 years? The only way in which real estate values would go up slower than inflation is a scenario in which the United States and all other countries of the world balance their budget. Because what is causing real estate to go up faster than inflation is the same thing that is causing other things to go up faster than inflation, including food. And that is countries spending more than they make, right? The United States is running trillion-dollar deficits. Everyone else is trying to outdo us. We're the best looking pig in this damn pigsty because every other country wants to run even bigger deficits than we do. Well, as countries run ever bigger deficits and the economy becomes more and more of a Ponzi scheme, people that are smart tend to move to alternative assets because there's only a certain number of real estate. We cannot have an exponential increase in real estate, right? We can have an exponential increase in the Turkish lira, in the Argentinian peso. That's what's happening. They're printing more and faster. But you can't print real estate. We roughly increase real estate in the United States by 1% a year. If you have a really good year, you can increase it by 2% a year. But you can't do what they're doing in Turkey, which is doubling the total amount of money in circulation in a single year, right? And because of that, you're seeing the value of real estate double in a single year, right? So money printing is the single most reason I am very bullish, not only on the fact that we have higher inflation ahead of us. Yes, it may not be 3.5%, but we're seeing that 2% inflation numbers are gone forever. It could be 2.5, it could be 3. And I'm not afraid of that scenario because it's beneficial for real estate. That's why I invest in real estate. So I actually think that if it stays at 3%, that's awesome. But if it goes back down to 2%, well, we were still making money before. We'll still make money. It's not a super sexy scenario, but it's not a bad one.
No, that makes sense. I appreciate you sharing that. And man, what great advice and insight during this show, Neal. Any other last parting advice for inspiring real estate investors out there before we wrap this up?
Don't do what you did in 2008. When I was going around and buying a single family home every month in 2008 and 2009, I had plenty of advice. Everyone gave me the advice that either I was a fool, a true idiot, or just like the world's greatest moron. Those were the three categories that the advice came in. That's what's happening to investors right now. The last 24 months of stress, problems, cash calls, lack of cash flow in multifamily has blinded investors to the opportunity today because they've started to believe that the future looks like the past. Well, there's only one guarantee in life. The future never looks like the past.
Makes sense. And Neal, if someone wants to get a hold of you, how would they reach out and get a hold of you or your team?
We publish a lot of interesting data around real estate and what's happening in the marketplace on a website. It's free and always meant to be free. There's no subscription, no upside, no education, nobody telling you to buy anything. It's called multifamilyu.com, multifamily followed by the letter u.com. We do a bunch of interesting webinars around things that catch our interest, like the dollar's supposed demise. That's coming up next month. We did a webinar last month that talked about why banks are not going to be distressed by commercial real estate loans coming due. So stuff like that is on this website. That's the best way for you to join our community. It has nothing to do with investing. And 6 times a year to people that are in that community, we send emails about and invites on our projects. And if that's interesting, go watch those. If not, stay in our community forever. Never pay anything. multifamilyu.com.
Perfect. Well, thanks again, Neal, for coming on the show. And to our listeners, make sure to go check out multifamilyu.com. And please do remember to leave us a rating and review. Helps us bring on guests like Neal. And we'll see you next week on Tuesday for yet another episode of the Keeping It Real Estate Show.